Hey everyone, welcome back to NumiSphere. Today, we're diving into a crucial topic for anyone interested in finance evaluating financial risk. Specifically, we're going to compare credit ratings and financial ratios to see how they help us understand the financial health of a company. What are credit ratings? Think of credit ratings as a report card for a company's ability to pay back its debts. Credit rating agencies like Standard & Poor's, Moody's and Fitch evaluate companies and assign them ratings based on their credit worthiness. These ratings typically range from AAA, which is the highest rating meaning very low risk, to D, which means default, indicating the company is not paying its debts. Imagine you're considering lending money to a friend. If they have a good track record of repaying you and have a steady income, you'd feel confident lending them money. Similarly, a company with a high credit rating is considered low risk and likely to pay back its debts on time. What are financial ratios? Financial ratios are tools used to analyze a company's financial statements. They help us understand various aspects of the company's performance and risk. Some key financial ratios include debt-to-equity ratio. This ratio shows the proportion of debt compared to shareholders' equity. A high ratio might indicate higher risk because the company relies more on borrowed money. Current ratio. This ratio measures a company's ability to pay short-term liabilities with short-term assets. A ratio under 1 might suggest liquidity problems. Interest coverage ratio. This ratio indicates how easily a company can pay interest on its debt. A low ratio might suggest trouble in meeting interest payments. Suppose you're considering investing in two companies. Company A has a high credit rating but a high debt-to-equity ratio. Company B has a lower credit rating but a lower debt-to-equity ratio. These ratios and ratings together can give you a better idea of the overall risk. Comparing credit ratings and financial ratios. Credit ratings provide a broad, third-party assessment of credit risk. They aggregate various factors into a single rating, offering an overall view of how risky it is to lend to or invest in a company. Financial ratios, on the other hand, offer detailed insights into specific aspects of financial health. They allow for a deeper dive into areas like liquidity, solvency, and operational efficiency. When it comes to the source, credit ratings are produced by external agencies with their own methodologies. These agencies consider various financial ratios, but also look at qualitative factors like management quality and economic conditions. Financial ratios are derived directly from a company's financial statements. They are useful for a hands-on analysis of a company's performance and risk, based on its own financial data. In terms of use cases, credit ratings are useful for getting a quick sense of overall credit risk and for comparing companies on a high level. They are ideal for investors and lenders who want a summary judgment of credit worthiness. Meanwhile, financial ratios are helpful for detailed analysis and understanding specific financial strengths or weaknesses. They are useful for investors, analysts, and managers who want to dig into the company's financial details. Real-life example: the 2008 financial crisis. During the 2008 financial crisis, many companies had high credit ratings from agencies, but struggled with poor financial ratios, especially in terms of debt and liquidity. For example, credit ratings. Some financial institutions had high ratings just before the crisis, but faced severe financial trouble when the actual risks came to light. Financial ratios. Looking at financial ratios like debt-to-equity ratios and interest coverage ratios could have provided earlier warning signs about the company's financial stability. Financial implications for students. Investment decisions. Understanding both credit ratings and financial ratios helps you make more informed investment choices. Don't rely on one measure alone. Use both to get a fuller picture of a company's financial health. Risk assessment. Combining insights from credit ratings with detailed financial ratios allows for a more comprehensive assessment of financial risk. Financial analysis skills. Mastering both credit ratings and financial ratios enhances your skills in evaluating companies, which is crucial for careers in finance and investing. In summary, credit ratings give you a quick snapshot of a company's credit risk from a third-party perspective, while financial ratios provide detailed insights into specific financial areas. Using both together helps you get a well-rounded view of a company's financial health and risk. If you enjoyed this video and want more insights into financial concepts, make sure to hit that subscribe button, comment, and share if you found this explanation helpful. See you in the next video.